Welcome and thank you for joining us today for our program, Key Considerations in Insurance Brokerage Transactions. My name is Meagan Kalantar and I am joined by my colleague, Trevor Wind. Bear with me while I try to get my PowerPoint presentation to function. There we go. There we are. Just before we get started today, a couple of housekeeping items to go over. If at any point during the presentation you have questions, you can use the Q&A button at the bottom of your screen. Time permitting, we will turn to questions at the end of the program. If you are having any audio or technical problems, please use that same Q&A button at the bottom of your screen, and our helpful marketing folks will help you work to get those resolved. And then finally, no need to take furious notes during this presentation. We will provide you with a copy of the PowerPoint presentation at the end. So with that, let's kick it off. Okay. We know that a number of you on the line with us today are familiar with the insurance agency industry and business, but others who are joining us are not. So we thought we would spend just a minute or two talking about the insurance agency business and giving you some background on how they're structured. Trevor, can you give us just a quick overview of the key features of an insurance agency business that makes these types of transactions a bit unique?
Sure. So it's important to understand how the agency functions, the revenue streams that it has, to make sure that those revenue streams are protected through the transition over to a prospective buyer. So agencies are largely commission-based. They do have kind of alternative fee agreements in place sometimes, but those are not the norm. Largely, the agency is going to sell an insurance policy to a client or an insured. That client will either pay the entire premium directly to the carrier, direct bill, and then the carrier will remit part of that back to the agency as their portion, or the client will pay it to the agency directly, being agency bill, and the agency will remit a portion of that to the carrier. Where that becomes important in the transaction is if you have a large amount of agency bill, depending on how the seller has maintained their books, there is going to be a sizable payable to the carriers, and whether or not that's easily identifiable on the balance sheet or not is on a case-by-case basis. But if there is a large amount of agency bill, you're going to want to block and tackle that up front and try to ballpark as best as possible what that payable looks like prior to closing. Going into kind of how the commission structure works, leading into the relationships, largely these are relationship businesses, as any businesses in the financial services space. That starts with the client. These arrangements with clients are at-will agreements. There are no long-term contracts with clients for the most part. Clients can leave at any point in time. They cancel their policy, move their business to another agency. So it's very important to protect the other relationships that you can protect from a legal perspective. Those other relationships are producers. Those can be internal employee producers. They can be independent contractor producers. It's important to get in front of the material ones on the buy side and make sure you identify those on the sell side as well, to make sure that that business continues to operate as it did pre-closing, post-closing. If a producer leaves and is not bound by restrictive covenants, what's going to result is there's going to be a loss in revenue. And that's not what the buyer is hoping for. And the seller in most of these transactions will have an earnout component. If they start losing revenue immediately post-closing, it becomes exceedingly hard for them to get the benefit of that earnout payment 2-3 years down the road. The last relationship is with carriers. It depends on the buyer, but in my experience, that's the least important of the three, although you wouldn't think that at first blush. The reason being is that buyers of a certain size have existing relationship with the lion's share of the carriers that are out there, and it's not an issue porting that business over from those carriers.
Yeah, that's a good point, Trevor. I mean, the primary asset of the insurance agency is this revenue stream. And because customers are free to sort of come and go and take their business with them at will, the best sort of measure of the stickiness of the continued revenue is the relationships between the agent and its customers. And often we see, what makes an attractive insurance agency target is a company that's pretty well integrated into, the area in which they operate, and, have been kind of an institution for decades in that area and have those solid relationships built up with their customers. So, all right. Next, we want to talk to you guys a little bit about how we typically see insurance agency deals structured. So Trevor, do you want to walk through that for us?
Yep. So in the space, we see predominantly asset purchase agreements. I don't want to say exclusively, but I've never actually seen a stock purchase agreement in one of these transactions. That's largely driven by the fact that a lot of sellers are going to be, they're going to have very strong businesses, very strong revenue streams, which is why they're attractive targets for buyers. But they may not have the size that would allow them to have the expense of being able to protect themselves from a legal liability standpoint, the way that they otherwise should. And so buyers are going to want to cut off liability immediately at the closing date to say everything prior to closing, how you operated the business, is your liability, and we're taking everything post-closing as far as running the business and the liabilities that come along with that. The other reason we see asset purchase agreements being the norm is that it allows the buyer to step up their basis in the assets to be the purchase price and get the benefit of amortizing that purchase price over a certain period of time. We do see pushback from sellers on the buy side for wanting to do stock purchase deals. And in 95% of those cases, it's a seller that's taxed as a C Corp. So they're trying to avoid the double taxation that comes along with an asset deal. One workaround that we found to that is relying on the Martin's ice cream case, which has held that personal relationships can't be owned by entities, they're owned by individuals. So as long as they meet a couple of tests, we're comfortable structuring the transaction as a partial sale for the assets, partial sale for personal goodwill. And that allows a large chunk of the purchase price to flow directly to the principals of the owner, and thereby avoiding that double taxation and making the transaction more palatable for sellers. The last two things just to hit on is that, like I've mentioned previously, earnouts, contingent consideration is very much the norm. Those can come in 1 year, 2 year, 3 year chunks. They can be EBITDA based, they can be net revenue based. They come in different forms and fashions, but it is normal in these transactions to have that incentive in there to continue the growth of the business post-closing. And the last piece is that if you have a buyer that is working on a roll-up strategy, doing multiple transactions a year, it's also typical that there's going to be some equity component to the purchase price. Again, further aligning the selling entity, the principals that are coming over with the overall growth in the buyer's business.
Yeah. And that personal goodwill structuring, not to get too deep in the weeds here, but on occasion where we have a C corporate seller, they are sometimes disappointed to learn that if they have entered into those kinds of restrictive covenant agreements that are so important to safeguarding these relationships, that they won't be eligible for the personal goodwill sale treatment in the deal. So non-competes can blow that up for them. And on the contingent consideration aspect of it, my experience is it's often a significant portion of the purchase price that gets tied up in the form of an earnout. Somehow, on the order of magnitude to a third of the overall consideration, to even 50-60%. So
yeah,
that's the mechanism I see.
Question that Cameron put up there about the amount, and it really just depends. And it depends if you're representing the buyer, you don't really care how much is allocated. It's a seller issue. If you're representing the seller, it's important to have a good accountant that's able to analyze the business and come up with a number that they can stand behind if it's challenged by the IRS.
Yeah. Okay. Let's talk about a couple of due diligence issues that we often encounter. Trevor, can you walk us through these?
Yep. So overall, relatively speaking, the diligence process on these transactions is light. Carrier contracts probably make up about 80% of the contracts that are going to be assumed in a transaction. And most sellers are not of a size where they're going to have a tailored agreement with a carrier. It's going to be the form of agreement that the carrier has every agency sign. It's a take it or leave it proposition. And so the buyer understands what those agreements look like. They understand that they're going to require consent. They understand that they're going to be indemnification obligations related to those agreements because they've seen them in each transaction that they've done. Producer relationships are the most important diligence item that we see. Again, making sure that you identify both on the buy and sell side the material producers to the business. Make sure that you have existing enforceable restrictive covenants with them. That means, one, making sure that there's an existing agreement that the seller has with that producer, and two, doing the employment diligence on that to make sure that the restrictive covenants are not overly broad and actually enforceable against that producer. If you don't have enforceable restrictive covenants, sellers should be prepared and buyers should want and push for those producers to sign their agreements immediately at closing or in connection with closing. We also run into some incentives that agencies will put into producer agreements. Either there could be a trail in commissions upon retirement, and there could also be a partial ownership of their book of business. On the trail, that doesn't create a legal issue, but it creates a business issue because, again, you want to maintain those relationships. And if a producer feels as if they're leaving money on the table by coming over to the buyer and entering into a new employment arrangement where they don't have that trail on commission, they're not going to be excited about that. So buyers will push for the seller to negotiate a payout of those trailing commissions. And on the ownership of the book, seller can't sell what it doesn't own. So if it doesn't own 100% of the book that a producer services, then the seller is going to have to negotiate the buyout of that 50% ownership. A lot of times that happens in connection with closing, and the purchase price is just reduced by that payment to the producer and just paid directly from the buyer to the individual producer when it's papered through the funds flow and in the purchase agreement with that producer. We run into things on a case-by-case basis that probably aren't worth diving into in detail here. Those can be litigation, E&O claims, licensure issues. On the real estate side, we also, most of the time, to your point, Meagan, earlier about having roots in a community, the buyer is going to want to assume the locations where they are. You know, that's part of not disrupting the business and not disrupting their clients. So likely they will assume the existing leases. So there's the review of the leases to make sure that those are market. If they're affiliated party leases, which you run into a good amount because it makes commercial sense for an affiliate of the agency to own the actual property, then they will likely enter into new agreements with those affiliates on their terms.
Yep. Okay. Just a couple of other considerations to mention here. We're kind of running low on time, but we did want to hit on some of these other important points. Trevor, can you talk to us about these?
Yeah, we've talked about restrictive covenants a couple of times. Non-competes, non-solicit confidentiality requirements, they're going to be in the purchase agreement. They're going to be in employment agreements. If there's an equity component, they're going to be in there too. A little harder to enforce in the employment context. And so for that reason, it's important to have them in the purchase agreement with respect to the seller and the principals, as well as the equity documents. Joint and several liability is the norm in these transactions. If you are a partial owner of an agency, you can expect that there's going to be a hard push to have joint and several liability between you and the other owners of that business. And it's up to you to contract amongst yourselves how to divvy up that liability if it ever were to come to pass. Caps and baskets are also the norm. Baskets are not I'd say their market for other transactions, 1 to 2% of purchase price. Caps are going to be considerably higher, probably 40% or higher. And if you're on the lower end, you're probably dealing with a much higher purchase price than normal. And the other unique aspect of these transactions is there is no indemnity escrow. Again, I don't want to say that you'll never see it. I've seen it once. But it didn't start out that way, and it was a protection that the buyer insisted on based on some issues that were uncovered in the diligence process that they needed to be comfortable closing. So you may run into escrows, but they're not the norm in this space.
That's consistent with my experience as well. The handful of times that I can recall indemnity escrows being demanded by the buyer were when litigation or errors and omissions kinds of issues were uncovered, and there was some potential, perceived potential on the buyer's part for that liability to follow over. So not the norm. Typically, the contingent consideration in the form of an earn-out is how the buyer gets comfortable that there'll be recourse available to them. That coupled with the joint and several liability that you mentioned, Trevor, where we get the individual owners of the asset seller to sign and stand behind the indemnification obligations of the company. Okay, we are officially out of time. But if you asked a question and we did not get to it, we will reach out to you directly. We really appreciate your time and attendance of today's program and hope everyone has a wonderful day. Thanks a lot.